The trade war was on Fed Chairman Jerome Powell's mind Wednesday as he wrapped up the last meeting of 2019. He unanimously, along with the FOMC, his crew there, agreeing to keep interest rates unchanged and signaled it would keep them on hold through 2020, but was sure to make clear that it was the U.S. China trade talks that had the world holding its collective breath. Well, now that phase one is ready to be signed and the Dow, we just mark it here, up 2 3/4 points, what direction will borrowing rates eventually take? Here in a Fox Business exclusive, the number 2 man at the Federal Reserve, FOMC Vice Chairman Richard Clarida. Welcome. Thank you for being here.
Yeah.
All right. Through your lens at the Federal Reserve, how does this phase one trade deal look to you?
Well, it's too soon. What I would say, Liz, is any reduction of uncertainty is a good thing. I think uncertainty about trade policy has been a factor in the economy, and so any resolution of that uncertainty, assuming it's a good deal, is obviously a positive for the economic outlook.
Well, Powell, as we had mentioned, the chairman of the Federal Reserve had said that it was not USMCA or any other trade tensions that mattered to the markets and to the economy. Everybody was watching this trade deal with China. Now the president is saying that it will add markedly, even just this phase one deal, to gross domestic product, meaning growth here in the United States. Could you say that phase one, from what you can see here, will add to GDP?
Well, again, it's too soon to tell, and I don't know what the details are, so I will hold off on that.
Is that part of the problem, that we don't know the actual details?
Well, again, I think this is obviously a negotiation. It looks like it's going in a positive direction. But more broadly, Liz, what we've said is that global developments more broadly have been something we've been monitoring. You've had a global slowdown this year. There are emerging markets have been slowing down. There are muted inflation pressures. So it's not just any one thing that we're focusing on.
Can you characterize the U.S. economy right now for us?
I think, Liz, the economy's in a good place. We have the strongest labor market in 50 years. We have low and stable inflation. We have solid growth. And our baseline outlook for the economy is more of the same in 2020.
Why do you say good versus great? I look at this and I check metrics. I deal in facts only. I tune out the politics.
Yeah.
It looks great, at least here in the United States.
Well, again, you have very solid growth of around 2%, different views on what the underlying trend growth is. But again, going into next year, I think we have a favorable outlook for the economy.
So we just got a great November jobs report, a gain of 266,000. And then we got this kind of disappointing retail sales number this morning. November retail sales missed. They were definitely light. They came in at up 0.2%. The expectation was a gain of 0.5%. Do you see any signs, Vice Chair Clarida, of the consumer pulling back?
We really do not. In fact, I've said and I believe that U.S. consumers never been in better shape in my professional career. In the aggregate, we've got a high savings rate. Consumers have been delevering. Income gains are strong. The unemployment rate is low. Obviously, it's 300 million people in the economy, but on average, in the aggregate, the consumer's in great shape.
Okay, so we have interest rates for all of next year, according to the Fed chair, at 1.5 to 1 3/4%. We also saw this, and this, of course, means that borrowing costs will remain incredibly low. Borrowing to get a mortgage on a home, to get a car loan, anything like that. We saw the credit card debt is now at a 10-year high. Does that worry you? Do you look at that and say, you know what, that's disconcerting, that's worrisome, or I'm okay with that?
Well, Liz, if you look at overall household debts, you have to look not just at credit cards, but mortgages and auto loans and all the rest. Actually, debt-to-income ratios have been falling, really, for the last decade. The U.S. consumer's been delevering, and, of course, debt service payments are lower with lower rates. And so the U.S. consumer, in the aggregate's in very good shape.
Now, we had heard just months ago, there's a recession coming, the yield curve inversion.
Yeah.
What dissipated all those fears so quickly to get us to the point where we see the sun shining now on the U.S. economy?
Well, Liz, at the time, I thought those fears were overblown. I thought the fundamentals in the economy were strong. I would point out that under Chair Powell's leadership, we put in place some adjustments in policy this summer. It will take time for the full effects, but we think policy's in a good place, and it's been providing support to the economy through that tough stretch this summer.
Well, then, yeah, so 3 interest rate cuts over the past year. The Fed now says nothing for 2020. That, if you interpret it through a political aperture, indicates that leading up to the 2020 election, the Fed is going to stay out of it. When the minutes from Wednesday's meeting come out in a couple of weeks,
3 weeks,
will we see the word election year at all in there? You guys don't want to be politicized at all.
Well, you absolutely will not, because it simply does not come up in the meeting.
So election year, anything like let's not get twisted?
No, as you mentioned, we put in place these adjustments in the face of this inverted yield curve. You had the ISM index below 50. You had declining inflation expectations. We were just doing textbook monetary policy to provide some support for the economy in the face of these global slowdown and muted inflation pressure.
Well, you got to talk about President Trump when we're talking about we don't mention election year, et cetera, but the president tried to tweet talk the Federal Reserve into much lower rates. In fact, he even pined for negative interest rates. Are negative interest rates appropriate right now?
Well, Liz, I think what the record shows is that the countries that have negative interest rates in Europe and in Japan are really lagging behind the U.S. Negative interest rates are a symptom of an underlying problem and challenge. You know, strong and growing economies and robust economies are not operating with negative rates, and so we don't want to be in a situation where that's a factor. And indeed, I should point out, at our meeting in November, we discussed negative rates, and as the minute showed, no one around that table of 17 had any particular support for the idea.
If the U.S. economy moderately weakened in 2020, would that make it appropriate to bring us to negative interest rates?
Oh, well, that's not something I would foresee, not at all.
Okay.
No.
Last time you and I spoke, the Federal Reserve had 9 quarter-point rate cut arrows in the quiver, meaning these are weapons that you can use to battle things like an economic slowdown. That was in July. Now we only have 6 quarter-point rate cuts. Is that enough if we ran into some real trouble?
Well, that's a good point, Liz, and I think our focus since I did your show and then is really let's put in place the policy that keeps us out of that situation. We thought it was better to put in place some insurance against those outcomes than to wait. You are right that we are operating now, Liz, in a world, not just in the U.S., but globally, of lower rates, and that means central banks will have some less ammunition. But we think we're in a good place right now.
Can I talk about the Fed balance sheet? And we're not going to get too wonky here. We're going to speak in regular language here.
Friday the 13th, not too wonky.
The Fed balance sheet has gone in the past couple of months from $3.8 trillion to $4.07 trillion, meaning it, albeit slightly, is expanding. Expansion rate of about 28%. Chairman Powell had said that the asset repurchases that he was going to start a couple of months ago, because you guys stopped selling off the balance sheet and bringing it down, was a little bloated, that was not quantitative easing or a stimulative move. How is it not if the balance sheet is expanding?
Liz, it's a very good point, and what the chair's indicated is that in these operations, we're buying T-bills. We're buying very short maturity, 3-month government obligations. Quantitative easing under the past at the Fed has been to buy mortgages, 10-year treasuries to lower long-term yields. We've really just been providing liquidity to the financial system. This was in response to those dislocations in the repo market in September. This is going to result in an increase in our balance sheet, but not through QE, but just by buying T-bills, which is the way central banks traditionally increase their balance sheet.
Well, so could I ask when that is going to end?
Well, what we've said is that we would expect the process of accumulating T-bills at the current pace to end sometime in the second quarter of next year.
Okay. The repo market. Again, I don't want to get too wonky here, but this is the very short-term overnight lending market that showed some very serious stress just, I believe, in September.
In September.
The Fed started pouring money in there, and now I see that they'll pour in, what, about $75 billion December 31st through January 2nd, so that if anybody's desperate for cash for year-end tax payments, et cetera, it will be there. I guess my question is, is that going to be enough if there's suddenly a run and people desperately need some cash?
Well, first of all, let me just say that will not happen. We will put in place what we need to provide the liquidity at year end. The markets are functioning well with the plan that we announced in October that we have in place. It's been well known that this market does tend to get a little bit moving in year end, and so we're providing this liquidity, but we will adjust the parameters as we need to avoid any problem in implementing our policy.
My sources are telling me that early next year, the Fed will talk about altering in some way, shape, or form its long-standing framework, how it looks at things like interest rates, how it looks at communicating forward-looking sentiment. I want to just whip through some questions. Will there be press conferences after every Fed meeting next year?
That is certainly the plan, and I can't foresee that changing.
How about forward rate guidance? Will you change that at all?
Well, forward guidance has been a tool that the Fed has used for a number of years. It's certainly in our toolkit now. I don't see us taking it out of the toolkit. That'll depend on individual circumstances.
Perhaps more importantly, when the next financial crisis comes, will the Fed change or alter the way at the speed at which it did its bond buying?
Well, again, what we have said is that as needed, all the tools in the toolkit will be deployed as needed. Obviously, individual circumstances will dictate the timing and the sequencing, but certainly we're going to use our full arsenal of tools in the next downturn.
Last question.
Yeah.
We'd be remiss if we didn't bring up the former Federal Reserve Chair, Paul Volcker, who died on Sunday at age 92. Yeah. His legacy, because he slayed stagflation.
But, Liz, I got to tell you, it puts chills. Paul Volcker is my hero. I have an autographed picture of him in my office. I had the chance to meet him and work with him 20 years ago. He's truly a giant of 20th century economic policy, one of the top 2 or 3 economic policy payers of the last 100 years. Absolutely will be missed. An incredible individual of integrity, honor, and it was a privilege to have a chance to work with him.
Richard Clarida, Vice Chair of the Federal Reserve, happy holidays, and thank you so much for joining us.
You bet.